Hey everyone, this is Diraj Goel, founder of Get Fresh Ventures. We're a venture partner where we help growth to exit stage companies build systems that take them from traction to scale to exit. This is Growth by Design, a podcast where we have conversations with leaders who've engineered a leap into entrepreneurship and have built companies. Some have scaled. They've developed leverage in their lives so they can actually live like humans and have defined what success means to them. Today, I'm speaking with someone who spent 31 years on the other side of the table, helping founders, being a founder himself, but helping founders raise capital, find acquirers, and navigate the deals that ultimately define the value that they created in their companies. Brent Holliday is the founder and CEO of Garibaldi Capital Advisors, one of Canada's most active technology investment bank. Brent has seen it all. He was an Internet 1.0 operator, a co-founder of a company that became Maximizer Technologies. If you're old enough, you know what that brand means. It was CRM before CRM. And he spent 13 years as an early stage VC. For the past decade, he's been the Canadian guy tech founders call here when they're ready to raise serious capital or sell. Garibaldi has completed over 55 transactions, totaling over $1 billion. That's a lot. Brent writes the monthly Tech Talk column for BC Business, speaks at Tech Exit and Startup Fest, and frankly knows where all the bodies are buried in tech deals. In fact, I met Brent during the Vision Critical days when I was there, and we were doing a raise and a partial exit. And that was back, I think, in 2016. So it's been 10 years. So, Brent, you've seen it all. I like to think I've been in the business for 30 years, but I was 15 when I started back in 93, 94.
Yep.
But you've been in it for 30 years.
It's been a while. Makes me feel old.
I think we're all old at this point, but
Yeah.
Tell me about it. Give me a run through of the journey.
Well, the journey was, I was at UBC and doing my MBA. And it was, again, how old am I? It was before it was called the Solder School. And we had a prof named Rafi Amit. And Rafi would bring in Haig Ferris, who was the founder of Ventures West, was involved. He'd bring in people that were in the community, Norm Francis, et cetera, Don Matrick, sort of the, at the time, the luminaries of Vancouver tech. And Rafi, who's now at Wharton School, and I believe he's now emeritus from Wharton, he took shine to myself and Garen Hellman and Heather Conradi and said, you guys, your business plan, we'd like you guys to, go to a competition in Texas. So you need to really develop this on the side of all your courses. I want you to write the perfect business plan for a tech startup. So that's what we did. That's how I got started in tech and focused on tech and had interest in tech, was right out of that course.
Was that the inception of Maximizer, or did that come after?
No, it was, so Maximizer was already existed at that point and was it was called Modatech. It was a publicly traded company. I met Terry Huey and his brother Joseph, and the three of us founded a company. And I thought Terry wanted me to write a business plan for all of these new internet businesses that were emerging. And he goes, no, I just want you to do it. So it was Terry, Joseph, and I that founded it. He came to my kitchen table one night, as Terry does. He likes to work around midnight on the software tech because he was running his Concord Pacific business. And he said, at my kitchen table, we should buy Modatech. It's in trouble. It's the Maximizer. And I said, that would be fantastic. I can think of all these different things that we can do with the internet around CRM, well, at the time called contact management, right?
It was called contact management.
Your
management. Biggest competitor was Symantec.
Act. That's right. It was Act and Maximizer. So that's what happened. We acquired, suddenly we went from 20 people to 100 people, and we started to develop businesses around Maximizer. And then it was going quite well. I had hired Rich Osborne, who then went on to TELUS Ventures. He worked with me
TELUS Ventures,
and then TELUS Ventures. I hired Andrew Webb, who then went to SAP. Dave Kohar, who's now sold 2 or 3 IT companies in Seattle. Bim Parmar, he's done a few tech startups. This was the crew that we put together there. And then I got approached actually at Terry's Christmas party by Livia Mahler to say, you should come and do growth company creation for a newly created seed fund. And I said, well, that sounds interesting. She said, yeah, it's venture capital. And I said, what's that? Because we didn't have to raise money. Terry had the money. I wasn't, I'd heard of what venture capital was, big raises in the valley and whatnot. But It was not my world. And it was shortly after that, Terry was taking the company public, and I had run my course there where I think I was like a 28-year-old, president of the organization. And I knew I was about to be removed when it went public. So I took my leave to go join Livia and eventually Rich Osborne, and I became a VC. So I spent
Hmm.
another 12, 13 years doing early stage investing, raising a fund. So BDC was the company I was working at, but we were working with Ventures West and another group to do the seed investing. And it was interesting times. What did I invest in? Encompass Labs. Boy, this is way back in the late 90s in Vancouver. There were a few investments I did in seed stage companies. Everything was mayhem back then. That was crazy
Yeah.
time.
It was the Wild West at
It
that
was
point.
nuts.
Yeah.
People think that
Yeah.
the bubble that we just went through was a bubble.
No,
No, 99, 2000 was crazy.
that was an entirely new frontier that was
Yeah.
going to be everything.
Yeah.
And it has become everything,
Yeah.
right? So,
But it got ahead of itself,
yeah.
which might be a theme that we talk about on this podcast, actually. Anyway, so we raised a fund, a $40 million investment fund. And the whole thesis was Livia was Israeli Canadian. And she said, Israel's model I like, which is if we can't scale companies locally because they're tech heavy, but we don't have product management, sales expertise, access to capital markets, we should jointly develop them in both the US and Canada. So that was our thesis in 1999. And we went and raised the 40, and we had special limited partners in the US from the Bay Area that Rich and I flew down and met. Ken Levy was one of them. He is the founder of KLA Tencor, one of the biggest semiconductor capital equipment companies in the world.
Hmm.
Peter Wolkin, John Michelson, who sold his company to Cisco. So we had a great group of people helping us. And the thesis was we were going to find incredible teams and talent and marry it with United States expertise to grow and scale companies.
Hmm.
Every investment we did in Greenstone was a co-investment with US VCs. So we co-invested with Norwest Venture Partners, Battery, Morgan Thaler, Mayfield, kind of who's who in the Bay Area.
And you got a very clear view of the early stages of VC
Yep.
in the US, and
Yep.
the foundation was built on.
Yeah, absolutely. I was down in either Rich or I were down there on Sand Hill Road almost every month. And of course, if we couldn't have timed it worse in terms of when we raised the fund and we started investing in March of 2000. So I often say if we had been a year earlier or a year later, I'd probably still be a VC. But we just went right down the backside of that drop. And it started in April 2000 with the dot-com meltdown. And then it was late November of 2000 when the networking crash happened.
Hmm.
Nortel went from, whatever it was, 150
Boom.
bucks to $5. And we went into the nuclear winter. Now, we still did, I think, a reasonable job. We sold a company to Adobe. We sold another one to Cisco. We sold another one to Nortel. We had exits, but we didn't have the venture home run.
Power of large numbers.
You got to have your 20 bagger, at least one of them, to
Yeah.
make up for the zeros.
Yep.
And it was a very hard time to get the 20 bagger, but we still managed to eke out a decent return. The first fund you raise is based on the dream and who you are, but the second fund you raise is based on results. And so the results of our only fund were not great. The bigger, more established VC firms that were around, they were forgiven because fund 8 was a bust. Oh, well, funds 1 through 7 made money for investors.
It's an anomaly for them based
Yep.
on the market. It's a badge for you.
Yeah. And we nearly raised the second fund in 2004, 2005 timeline because we added an individual who got to know us from the late 90s from Portland, Oregon, who was incredibly tied to HP and Intel down there and just a brilliant guy. So we were going to have a GP on either side of the border. We were really going to promote this particular thing. LPs just pulled out. And I think if you look today, what VCs are going through in Canada today,
Hmm.
there weren't very many of us back then. And we had these kind of crazy, weird competitors called labor-sponsored funds that don't exist today. But the market today for VCs is very much like it was then. It was very hard to get LPs to give you money because the returns haven't been there in the last couple of years.
And the stock market is ripping.
Yeah.
Which is competing for the VC dollars.
That's right. Yep. So we're in fascinating times, which I'm sure we're going to get into in a minute. But It was back then. It was difficult in 0405. We came so close to getting that second fund and getting going. And Yaletown Ventures raised their funds right around the same time. And I remember talking to the original founders, Mike Satterfield and Steve
Uh,
Natchik,
yeah,
and
I
Steve
know
Natchik,
Mike quite well. Yeah.
yeah, and Steve, and saying, "How do you, like you guys did it? You in this horrible environment, you got funded, and they're still around. They're still doing
Yeah.
very well. So it was a difficult time, and you're going to see that in the washout in the next few years of
Hmm.
venture funds here in Canada. A similar type of, and you know what happened after that, of course, was it got very tough for Canadian companies, tech companies, to raise money. Probably the hardest time to raise capital in the last 45 years was 2002 to 2007. It was brutal, even
Hmm.
though interest rates were historically low.
And you know what I was doing back then? I was working out of a chem lab
Yep.
at UBC, building out WebCT from the ground up.
That's right.
We were selling $3,000 licenses, and then
Yep.
we shifted to $250,000 licenses.
Yep.
I remember getting an email on Sunday because I ran all of technology and ops from the CEO saying, "Okay, we're going to have two rooms, this boardroom and this boardroom. Half the team's going to be here, half the team's going to be here. That group is going to be let go, and you guys are
Yep.
going to get to stay." We did that a few times. That it was a tough ride.
Yep. It was, yeah, I'm sure it was. You had to grind it out and get enough money from your customers because their capital just wasn't there. And meanwhile, in the US, the herd of venture had moved and started to invest very heavily because in the downturn, that they knew that was when you had to invest. And so if you think about what came out of that time frame, it wasn't until Google went public, I think it was September of '03, it might have been '04, that really the rest of the world woke up and went, "Oh, tech is coming back." And then Facebook was, shortly on those heels. And
Yeah,
then of
yeah.
course,
That was like 2006,
yeah. And
right?
then the
Like 2005,
smartphone. The other
2006.
thing
Yeah,
that pulled us out of that was the smartphone. It
yeah.
was BlackBerry to start, and then of course Apple and iPhone
As soon as
following.
2009 came around,
Yeah.
it
So
was
so
gangbusters.
so it was a new thing that tech could hold on to. That by the way, funny story. We talked about those VCs that we worked with in the Silicon Valley. Just so you understand, I was super impressed with some of them, and some of them I was like, "What?" And you thought these people were gods because they'd made so much money in tech.
Mhm.
So here's an example. I cannot name the person because they're very famous, but I'm in the boardroom, and we just had a board meeting for an investment that we had done, and I had an investment out of Ottawa that we had just made
Mhm.
that I wanted to introduce to this legendary VC. And I said, it's a chip, but the way that the chip works is it's more for photography and media. And so he said, well, what's it for? And I said, well, these newfangled smartphones that are coming out, we can put cameras in them, and they'll be able to take pictures. And he looked at me. This was 2003, and he said, why would anyone ever want a camera in their phone? That's the most ridiculous thing I've ever heard. So, sometimes they're not peeking around the corners well enough to see what comes
Mhm.
next. So anyway, after that, when I knew that venture wasn't going to work, I got into this side of the business, and I worked with a firm in Vancouver to learn investment banking. And I was the one tech guy with 10 professionals. Amazing group. They are still around. They do great work. And Capital West is the name of the firm. But I just said, well, I'm the one tech guy. And if we want to do tech correctly, you have to be all tech. And
Mhm.
so in February of 2013, I started Garibaldi, and it was all tech. And we were the first ones in Canada to be tech only
Focus and
investment.
pack.
Yeah, nobody existed. And funnily enough, one of my mentors, I talked to Boris and I talked to Paul Kudrowski, who's always been a mentor. And then I talked to Mark McLeod, and, he was in Toronto, and I said, I should really do this. He goes, you should really do this. And then he gave me all sorts of good tips, as Mark does. I came back a year later, and he was a CFO at FreshBooks. And I sat down and I said, Mark, I think you should be my Toronto guy. Let's
Mm.
go national. Let's go across the country. And he goes, yeah, well, let me think about it. And about 6 months later, he started SurePath, the other tech focused investment bank. he, he did that for about 5 or 6 years and then moved on. But I
Mhm.
thought that was funny. Anyway, we started Garibaldi. We were doing deals really only out west. So Vision Critical, the original broadband TV, 51% sale, that was us. We build direct. We raised some money for, I think, multiple times. Then we were into Cymax, and multiple times we helped them raise capital. And then we sold companies. We sold Kyle Campbell's company to Zillow. We were about half growth equity. And it was around 2017 where I said, okay, we need to expand. I came to Toronto, set up an apartment, and I was going back and forth trying to get networked again in Toronto with people. And I met Ryan De Silva, who had just left exiting a tech company. He was an investment banker for years, jumped into a client's company in the health compliance space and ran it for 2.5 years and sold it. And so Ryan came on as the Toronto partner. I went back to Vancouver and hired more people, and we're up to the 6 that we are today. Three are in Toronto, 3 are in Vancouver. And you said 55 off the top. That was slightly old. We're over 60 now. Transactions completed. We are about to celebrate, I think, next week our 13th birthday as Garibaldi.
Congratulations. That's
Thanks.
quite a journey. So, the first half of our life, we're just trying to go get it.
Yep.
And then the second half, we're trying to reflect back and
Yep.
synthesize and just figure ourselves out more.
hmm
After so many decades, how are you seeing what's happening right now in venture? The narrative, more lately than ever before, is that Canadian investors aren't investing in
Yeah.
early stage.
Yep.
There's a perception that there's not enough capital. I also see the constructs around government not being there in terms of the early starts. Like, when I left Hootsuite and got back into the world of startups at the early stage, back in 2016, we had BC Tech here, Wavefront,
Yep. Yep.
a bunch of, all partly government funded, but industry was pretty vibrant, but everyone seemed to kind of step back. We've got exited founders with capital. No one's putting that capital into VCs. VCs are expecting a lot more. What are you seeing?
Well, here's what's changed. In that desert we talked about in the '02 to '07 timeframe, there was no other place to go. There weren't enough angel investors, people that had made money. There was no such thing as growth equity for the later stage. That
Hmm.
that was a construct just being created in the US, and it really didn't come to Canada until Omer's Ventures got going in 2012 or so,
Hmm.
maybe a little earlier. 2010, Tandem and Omer's were the first growth equity. So the US had the ability to, in the US, you could find tons of seed money, angel investment. There was later stage money that was helping fill the gap at venture. In Canada, it was just a gap everywhere. Um, this time around, I see it a little bit differently. There's an incredible amount of money out there in growth equity and private equity that will decide whether they want to buy your company, a control position, or your entire company. And they're very tech savvy, or they'll look to do minority investments. So that's a company that's scaling past, 5 million in revenue. So what do you do when you're a startup? Today, there are far more family offices, as they're called, which is basically angels that are organized and have people that help
Hmm.
them do the investing than there ever was 20 years ago. And family offices are very prominent and prevalent. They're
Hmm.
doing a ton of investing in the early stage. There's also seed funds that are
Hmm.
organized as well that weren't there 20 years ago. So there's a breadth of type of class of investor that you can go
Hmm.
and seek money for today that wasn't there 20 years ago, and will help fill the gap that you just talked about, which I completely agree with. There's going to be less VCs. There's not as much government help unless it's defense, which is suddenly extremely hot.
Hmm.
And so it's changed in that there are more places to go and look. And ultimately at Garibaldi, where we have really found our mark, if you will, who are the people that we can help the most? It's often the bootstrapped or lightly capitalized companies.
Hmm.
It's not the venture backed. And a lot of our companies we sold a company called Lodestar out of Burnaby,
Hmm.
BC. And it was 3 individuals that built a great business after spinning out of the credit union software company, created their own credit union software company, and, we sold them for what was life-changing money. And I won't give you the value because it was kept private, but it was a very nice exit for these individuals. If I sold a venture-backed company for that amount, everybody would be howling because it would
Yeah.
be a disaster, and you wouldn't be, you know, they didn't make enough money. The liquidation preference would have kicked in. The founders wouldn't have had anything. So we generally don't do exits for VCs because we're not exiting at $1 billion. That's not us. But on the growth capital side, we are helping both bootstrapped and venture-backed companies raise later stage capital. I would say, circling back to the question, there's a lot more happening in the growth stage, which is promising. And there's a lot of different places to look earlier, which I also find promising. But it's not going to be 2020 or 2021 raising capital for a long time.
I have this constant challenge. Having been in venture backed and also worked with companies where outright I've discussed with the founders, don't raise,
No.
like run it on your own. I have a strong feeling for the latter. After being in the boardrooms and seeing
Mhm.
what happens to companies multiple times when you've got VCs at the table. And my perspective is that it's sometimes more meaningful to build a company that gets the 10 million that you can sell for 20-30 million dollars and put it all in your pocket
Mhm.
versus trying to build $100 million company where you put $20 million in your pocket. And I've seen that happen. There are some founders who raise so much that once they pay everyone off, they walk away with almost nothing.
Yeah. Well,
What's your experience of this? Because almost every founder I talk to, the perception is I need to raise money, and my immediate retort is, no, you need to go get revenue.
I completely agree. And I've been there. I've been a venture capitalist. I did that try to hit the 20 bagger home run type of analysis for years. And here's the thing. This is to your, do I just grow it on my own and sell it for 20 or 30 million, or do I go the venture route? Venture has always been and always will be the deal that says I'm going for $1 billion company. It,
Yes.
it has to be. And it's, you take venture to get there faster. You're going to, light this rocket and you're going to go. And
Hmm.
both parties have to understand that. The entrepreneur has to understand that's why I'm doing this. And the VCs understand and believe that this could be $1 billion company if we really give it a ton of capital. Canada, for years, when I was a VC and whatnot, we would underfund the rocket.
Yeah.
We would give them $5 million, and their competition in the US was getting 30. So that was a problem. But generally speaking, you're taking venture money because you really want to accelerate the business, and you're giving up the complete control of the business. You don't have
Hmm.
it. It's gone. And you'll never get it back. I used to say one of the things I didn't like about being a VC is I spent 75% of my time working to get nickels back from my investors, because the ones that get hard, the ones that you have to get into, are the ones that aren't working. The
Hmm.
ones that are dramatic successes, you really
You don't
didn't
have
do
to do
much.
anything. Yeah.
You
You
really
didn't do
didn't do
much.
much.
Yeah.
So you have to pick them correctly for sure and get the valuation right when you go in for sure, but you don't do much. So if you're an entrepreneur, things get ugly if the plan doesn't go anywhere near what you said it was going to do. And that's
Hmm.
when, the board steps in and starts taking action around firing personnel. It's where the next round comes in and it's a dramatic down round. And now you've got a layered cap table. You might have liquidation preferences. Now you're taking
Hmm.
on debt. And you've got this pancake of liquidation preference ahead of any of your common shares. And you might look up one day and go, I'm working so hard. If I do the waterfall correctly, I'm not going to make money until this thing's worth $500 million.
Yeah.
And so,
And you know what's interesting, Brent? When I explain this to founders, when you take venture money, you're signing up for a certain type of lifestyle
yes.
that you may not actually want.
Yep.
Let me walk you through what managing and running $100 million company looks like.
Yep.
You are not going to see your kids.
Nope. Nope.
You are not going to sleep in the same bed more than a half of the year,
You're going to
right?
spend
Like,
2 hours on a Sunday afternoon talking to your investors,
correct.
right?
Right.
Like,
So that's what your life is. Do you really want that? And
yeah.
I don't think that that is the perspective that most founders actually have.
Well, having worked with a lot of bootstrap companies now, at Garibaldi, I now have that perspective, right? I was venture and now I'm this.
Mhm.
And I don't want to cast dispersion at all on VCs, but, the world, the news funnel, the topics are about venture backed companies. You always,
Yes.
one example, a couple weeks ago, Fasken released, I love Fasken, sorry guys, but I have a problem with what they released. They released their report on exits, and it says venture backed exits. And they said that 75% of the acquirers were strategic. That is not correct. because, first of all, venture-backed exits only make up a small amount of the total exits that happen in Canada. And I can tell you, financial buyers are incredibly active. And financial buyers are the PE funds that buy companies. They're the
Mm-hmm.
aggregators like the Banyans and Constellations
Mm-hmm.
that buy companies. But then there are also strategics that are backed by and owned by private equity. So we
Mm-hmm.
call those PE sponsored exits. Well, that's actually a financial exit because the PE firm is the one that does the diligence and acquires the company, not the company itself.
Mm-hmm.
So as an example, everybody consumes that information and it's gospel, but it's not. That's only the venture backed sector that they're referring
Mm-hmm.
to, which, as I learned, is an echo chamber. There's all of
Mm-hmm.
the companies that are venture backable in Canada are usually quickly discovered within the venture universe, and they all talk about it. And so they get into the echo chamber of this is the venture opportunities. Outside of that are many, many, many successful companies. Now, they might not be
Mm-hmm.
growing at 100% a year. They might be growing at 20, 25% a year, but they're profitable and they found their
Mm-hmm.
niche and they're growing. Some of those bootstrap founder owned companies just, they catch lightning and in a bottle and they explode and they get big exits without having venture. The largest exit we ever did, and our range is, 15 to 100 million in exit value. The largest one we ever did was 105 million. And it was a father and son, an 8-person company that had 25 million in revenue and had about $12 million in EBITDA. And it
Those
was
are
in
beautiful stories,
and it was in the
and
payment
that's
space.
and that's what's significantly lost on founders, right? Like what you're building is an asset vehicle that drives cash flow
Yep.
and creates its own enterprise value,
Yep.
and you can live your life.
Yep.
That's a best case scenario,
Yeah.
right?
Yeah.
Like you don't need $1 billion. Most people don't want $1 billion.
I actually remember the father saying, "I don't know what I'm going to do with all this money." And I said, "Well, for a start, send your wife to wherever you want to go and spend your winters and have her buy a place."
Yeah. I mean, we share in founders we know who are on similar journeys. And the reality is that I think Canada will end up being stronger if we have more founders that are building. Having 1,000 founders getting to 10 million is way better than getting 2 to 1 billion, right? Like,
And in my business, our competition to represent a company selling in Canada is, there are a couple of other kind of tech related. There's a whole bunch of generalist firms that might have a tech guy with them.
mhm,
But the reality is the U.S. firms come up and they talk to the Canadian founders. But here's what they don't understand about the Canadian market, which is why I picked, having been in this market forever. Here's the 10 to $100 million exits. There are many of them in Canada. Many of them you never hear about. Many of them not reported because they're not in the venture echo chamber. And the pyramid should be the 100 to a billions. There should be a good, healthy amount of them selling between 100 and a billion.
mhm.
And then there's the above a billion, the big ones.
Yeah.
So up here, it's Goldman Sachs, Morgan Stanley, in Canada, the biggest like RBC, BMO, Canaccord.
Mhm,
In here is the Bairds, Blairs, Houlihan Lukis in the States. It's Canaccord and CIBC and a whole bunch of people in Canada. In the US, the pyramid works. There are lots of exits in this 100 to a billion. In Canada, it's like this. Look at the data. There's almost as many exits over a billion than there are between 100 million and a billion over the last 20 years. So
mhm,
what happens is the US bankers come up and they look for these companies and they don't find them. And that's an interesting comment on, you could probably take from what I said earlier, that we used to fund companies with 5 million while their competition was getting 30 to 50. Well, then they end up exiting below 100 million because they just didn't get
mhm.
to scale. It's just the whole reason I picked where we operate is because I understood that exit dynamic. And I have tons of conversations with other investment bankers about, well, where are the Jane apps and the Clios? They're there. There's a few of them, but there's not a whole bunch that are right below them in terms of
Yeah.
value.
Well, so a founder starting
Yep.
out, raising pre-seed, seed, what's your advice to this Canadian founders, especially with what Carney said, right? Like at Davos, we got the talent, we got the capital, we got the infrastructure, we've got everything what the world wants. And I wrote a LinkedIn post recently, and I agreed with it. Yes, we have everything
Mhm.
that the world wants, but we're just
Yep.
giving it away for pennies
Yeah.
instead of building wealth and prosperity here and keeping it here. What would you tell a founder raising today?
So I would say, first of all, it better be AI enabled or
Hmm.
or have something to do with it, or hot markets today, of course, in defense and that kind of a sector. Like any startup, you got to have a great team. You got to have a differentiated product that you're going to market with. There are so many. The advantage today over 20 years ago and then 30 years ago of your speed to market is unbelievable. The amount of capital
Hmm.
you require to get to product is ridiculously
Much less.
inexpensive than it was back then.
Hmm.
And so have the ability to iterate, to test, to A/B test, to do whatever you on your product. You have as I said, pockets of money that are there in the seed fund. So or family office to raise capital that isn't necessarily venture. I would say that the macroeconomic scenario is crazy. We don't know that the world is going back and forth weekly with things
Hmm.
going on. The smart investors and the smart entrepreneurs are not looking at what's happening in the next 3 months like public companies are. They're what's happening in the next 3 to 5 years.
Hmm.
Where are we going? Because that's the time it's going to take for you to be a success. It's going to take that long. So worrying about what's happening in the market today is not necessarily so. If you believe that in 3 to 5 years we're building relationships with Europe and Asia, then do that now. Start to build your network and how you're going to sell to the US or how you're going to sell to Europe or how you're going to sell to Asia. Start thinking about that now. Are there partners you have to develop? Do you build teams there? I think you're going to have to be thinking 3 to 5 years away, that it's not an easy jump across the border to your customers. You're going to have to think about something that is truly global.
Hmm.
I used to talk to US investors and say, think of Canadian software entrepreneurs as American because they basically sell to America from here where the labor is a little bit cheaper. And now I would say, I don't know if that's going to be the case. Of
Yeah.
course, the US market is there, but you've got to be thinking in the next 3 to 5 years again, where are the markets going to be? Plan appropriately.
Well, great advice, Brent. We're at the top of our time. Great conversation. I think there's just so much happening, and it's always good to get perspective.
Yep.
And we're going to be talking at Tech Exit next
Mhm.
week. I think you're on stage as well,
That's right. Yep.
right? It would be good to catch up and figure out what we're going to do about everything.
Yeah. Well, the conversations are going to be about, is SaaS dead? AI.
Hmm.
There's going to be fascinating conversations. And I think the markets did a knee jerk reaction this week around that. But
Hmm.
unpacking all of that is going to be fun because people are
Yeah.
worried. People are worried
Yeah.
right now. So
Yeah. Yeah. Well, thank you again for your time, Brent. Great to have you on the podcast.
thanks for having me.